From 2009 to 2021, the S&P 500 delivered an annualized return of over 16%. An entire generation of investors came to believe that this was normal. Then, in 2022, the market fell nearly 20%. A study by the research firm Dalbar consistently finds that the average investor earns dramatically less than the market indices because they do the exact opposite of what they should. They buy high in times of euphoria, and they sell low in times of panic. They are playing the game without understanding the rules or the season. In the next 10 minutes, you will learn the four distinct phases of the market cycle, the key psychological and economic indicators that define each phase, and a practical framework for positioning your portfolio to exploit, rather than suffer from, the market's inevitable emotional swings. A market cycle is the recurring, four-stage pattern of fluctuation that occurs in financial markets. It is not a predictable, clockwork event. Its timing is irregular, but its pattern is eternal. This is because market cycles are not primarily driven by economics or politics. They are driven by the unchanging, immutable engine of human psychology, oscillating between the two poles of greed and fear. These four stages are accumulation. This is the market bottom. The psychological mood is one of despair and capitulation. The news is terrible. The economy is weak. The public wants nothing to do with stocks. This is when the smart money, the disciplined long-term investors, are quietly buying assets at a deep discount. Markup. This is the uptrend. The economy begins to recover. Corporate earnings improve. The mood shifts from despair to cautious optimism, and then to excitement. The general public, having missed the bottom, starts to tentatively buy back in. Distribution. This is the market top. The mood is one of euphoria and greed. The news is fantastic. Everyone is an investing genius. Valuations are stretched to historical extremes. You hear the four most expensive words in investing. It's different this time. This is when the smart money is methodically selling their assets to the euphoric public. Mark down. This is the downtrend, the crash, or the correction. The economic data begins to weaken. The mood shifts from anxiety to denial, and finally to panic. The public, having bought at the top, sells in a wave of forced liquidations and capitulation, often at the worst possible moment. These four stages have repeated for centuries, in every market on Earth. The key to successful investing is not to predict the future, but to accurately diagnose the present. So, what are the specific, observable signs that define each phase of the cycle? Let's break down the tangible indicators for each phase. This is how you identify the market's current season. Theory. The indicators of each phase. Each stage has a distinct profile across three domains: psychology, valuations, and economics. During accumulation, the psychology is fear. Headlines scream recession or depression. Valuations, like the price-to-earnings ratio, are well below their historical averages. Economically, interest rates may have peaked and are beginning to fall as the central bank tries to stimulate the economy. During markup, psychology becomes optimism. The narrative shifts from problems to possibilities. Valuations move from cheap to fair value. Economic growth is solid, and corporate earnings are consistently beating expectations. During distribution, psychology is greed. Everyone is bragging about their profits. Financial news is overwhelmingly positive. Valuations become extremely expensive, far above historical norms. This is when you see speculative manias in the riskiest corners of the market. During markdown, psychology shifts to anxiety and then panic. The market starts making a series of lower highs and lower lows. The public, anchored to the high prices of yesterday, sells in a panic to stop the bleeding. Analogy: the master farmer's almanac. Think of a master farmer who operates based on a deep understanding of the seasons, while the novice farmer reacts only to yesterday's weather. Accumulation is late winter. It's cold, the ground is frozen, and the sky is gray. The novice farmers are indoors, convinced nothing will ever grow again. But the master farmer is out in the field, preparing the soil and buying high-quality seed, assets, at a deep discount. Markup is spring and summer. The sun is shining, the crops are growing, and optimism is high. The master farmer patiently tends to his crops, letting them grow to their full potential, letting winners run. Distribution is the peak of the harvest. The crops are tall and abundant. The sun is blazing. The novice farmers, seeing the success, are rushing out to plant new crops, believing the perfect weather will last forever. The master farmer, however, recognizes the signs of late summer. He is methodically and quietly harvesting his crop, selling it at the highest possible prices. Markdown is autumn. The weather turns cold. The novice farmer's late-season crops wither and die. They panic. The master farmer is already safely in his barn, counting his profits, waiting for the dead of winter to once again buy seed for cheap. This is the essence of cyclical investing. It is the art of acting as a contrarian to the prevailing emotional weather. This is the core of sophisticated wealth management. The theory is elegant, but its application is fraught with peril. Investors make two predictable mistakes. Pitfall number 1. The illusion of precision. Amateurs believe the goal is to perfectly time the exact top and bottom of the market. This is impossible. The goal is not to be a perfect timer, but a skilled navigator. Your objective is to be aggressively buying during the process of accumulation and methodically selling during the process of distribution. It is a game of probabilities, not certainties. Pitfall number 2. Believing it's different this time. These are the 4 most expensive words in investing. Every bubble is built on a narrative that a new technology or a new paradigm has rendered the old rules of valuation obsolete. But human psychology, the engine of the cycle, never changes. The details of the story change, but the emotional arc of greed and fear is a constant. Avoiding these psychological traps is the foundation. But how do you turn this knowledge into a systematic, actionable strategy? The pros use a specific tool to guide their decisions. The advanced strategy: build a cycle dashboard. The professional investor moves beyond gut feel and emotion by building a simple dashboard of objective indicators. This dashboard provides a clear, data-driven assessment of where we are in the cycle. You can build one yourself by tracking 3 to 5 key metrics. Valuation. Track the Shiller P/E ratio, or cyclically adjusted price-to-earnings ratio. This compares current stock prices to the last 10 years of inflation-adjusted earnings, smoothing out short-term fluctuations. Is it significantly above its long-term average? That's a sign of distribution. Is it significantly below? That's a sign of accumulation. Credit spreads. This measures the difference in the yield between risky high-yield corporate bonds and safe U.S. Treasury bonds. When the spread is wide, it means fear is high, and investors are demanding a huge premium to take risks, accumulation. When the spread is very narrow, it means investors are complacent and fear is absent, distribution. Investor sentiment. Use a contrarian sentiment indicator like the American Association of Individual Investors Bull-A-Bear ratio. When the percentage of bears is at a historical extreme, it's a powerful buy signal. When bulls are at an extreme, it's a signal to be cautious. You are not looking for a single signal, but a preponderance of the evidence. When all 3 of your indicators are flashing red, high valuations, tight credit spreads, and euphoric sentiment, you are deep in the distribution phase. This is the time to be fearful, to trim your risk, and to raise cash. When they are all flashing green, you are in the accumulation phase. This is the time to be greedy. This dashboard is a system for turning theory into disciplined action. Let's distill this into the three essential principles of cyclical investing. Markets move in four psychological phases. Your primary job as an investor is not to pick stocks, but to correctly identify whether the market is in a state of accumulation, fear, markup, optimism, distribution, greed, or markdown, panic. Be the master farmer, not the novice. The wise investor understands the seasons and acts as a contrarian to the prevailing emotional weather. They buy when the outlook is bleak and sell when the outlook is euphoric. Build a dashboard, not a crystal ball. The advanced strategy is to use a dashboard of objective indicators, like valuation, credit spreads, and sentiment, to make rational decisions. This system forces you to be fearful when others are greedy, and greedy when others are fearful. You cannot control the market cycle, but by understanding it, you can harness its power to your advantage, turning the market's emotional volatility into your greatest asset. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.